Welcome to our comprehensive guide on Fidelity bonds. In this video, we'll break down what Fidelity bonds are, their importance, how they work, and provide you with real-life examples to illustrate their practical applications. By the end of this video, you'll have a solid understanding of how Fidelity bonds can protect your business from financial loss. Let's start with the basics. A Fidelity bond is a form of insurance protection that covers policyholders for losses that they incur as a result of fraudulent acts by specified individuals. This is commonly used by employers to protect against employee dishonesty. Now, you might wonder, why are Fidelity bonds important for your business? These bonds are crucial because they offer financial protection and ensure that your business remains solvent even in the event of employee fraud. Without such protection, a significant fraudulent act could potentially bankrupt your business. Let's look at an example to illustrate this. Suppose you own a small accounting firm. One of your employees commits fraud by embezzling $50,000 from client accounts. In this case, a Fidelity bond would provide the necessary coverage to help recover the lost funds. Now, let's dive into the types of Fidelity bonds available. There are two main types: first-party Fidelity bonds and third-party Fidelity bonds. First-party Fidelity bonds protect the business from fraudulent acts committed by its own employees, whereas third-party Fidelity bonds cover losses caused by contractors or vendors working on behalf of the company. Here's a quick comparison. First-party Fidelity bonds focus on internal threats, such as employee theft, while third-party Fidelity bonds address external risks posed by non-employees who have access to the company's funds. How do you determine the amount of coverage your business needs in a Fidelity bond? The coverage amount typically depends on several factors, including the size of your business, the number of employees, and the amount of money that employees handle. Here's a simple formula to guide you. Coverage amount equals average annual revenue x risk factor. The risk factor can vary based on the industry and historical data of fraud cases. Let's walk through a question to better understand this. Suppose your small business has an average annual revenue of $500,000, and based on industry standards, the risk factor is 0.05. What would be the advisable coverage amount for your Fidelity bond? Using the formula, coverage amount equals average annual revenue x risk factor, we get coverage amount equals $500,000 x 0.05 equals $25,000. Therefore, it would be advisable to have a Fidelity bond coverage of $25,000. Now, let's look at some statistical data. According to the Association of Certified Fraud Examiners, ACFE, the median loss caused by occupational fraud is $125,000. This highlights the importance of having adequate Fidelity bond coverage. Quiz time. Before we proceed, here's a quick question for you. Which type of Fidelity bond would you need to protect against losses caused by your vendors? Is it A, first-party Fidelity bond, or B, third-party Fidelity bond? The correct answer is B, third-party Fidelity bond. This type of bond covers losses arising from fraudulent acts by contractors or vendors. It's essential to not only understand what Fidelity bonds are, but also how to effectively implement them. When choosing a provider, you should consider factors like the provider's reputation, the terms of the bond, and the cost. It's also prudent to consult with a financial advisor to tailor the bond to your specific needs. Here's a practical tip. Regularly review and update your Fidelity bond coverage to ensure it matches the current risk landscape of your business. As your business grows or the market conditions change, you might need higher or different coverage. To sum up, Fidelity bonds play a crucial role in protecting your business from financial losses due to fraudulent activities, whether it's through direct employee dishonesty or third-party fraud. Having the right type and amount of coverage can safeguard your business's financial health. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe for more finance tutorials. If you have any questions or need personalized advice, feel free to leave a comment or reach out to us directly. See you in the next video.